Good day, people. So for this video, we'll be covering Nike's most recent financial review, and we'll just cover their income statement and their balance sheet. And so to start things off, I'll show you where I got the information. I went to the Nike website and went to their quarterly earnings within their investor relations. And open this doc. And so I'll start with the first line. Nike reports fiscal 2026 third quarter results. And just so you know, these results are from December 2025 to February 28th, 2026. Um, First bullet here talks about the revenue. So we haven't even gotten to the income statement yet, but these are some quick notes. We're dealing with revenue of 11.3 billion in that three month time period. So from December 2025 to February 28th, 2026, they made 11.3 billion in revenue. Wholesale revenues were 6.5 billion. Wholesale revenue is just basically buying by the bulk, and so Nike has vendors that they sell to by the bulk, and this is their revenue that they received from them. And then they have Nike direct revenue of 4.5 billion, and so these pretty much sums up their revenue. And when they say Nike direct revenues, you can look at that as direct to consumer. And so they have wholesale, then direct to consumer. And so now let's get into, um, let's take a look at these notes. This the 11.3, we talked about that. Nike brand revenues were 11 billion. And so wholesale revenue 6.5. So we kind of talked about that. So we can just get into the actual financial statements. And so the first financial statement we'll review is the consolidated statement of income. And basically, when you're looking at the consolidated statement of income, people call it P&L, people call it statement of operations, but it's just a measurement of revenue minus expenses equals net income. And so revenue we already talked about, and that's the 11.3 billion. It's right here. That's the 11.3 billion. And so when you consider that, that's the revenue that came in from all sales. Now, you also have to consider the cost of sales. Nike is selling product. Whenever you have product, there's a cost to manufacture and produce that product. Well, that's the cost of sales here. And so the 11.3 billion that they made, we have to consider the cost of sales. And so when you subtract that, you get the gross profit. And so the gross profit is 4.5 billion here. And we are now getting into a much smaller number. And so the cost of sales is very substantial to that revenue. And so some people still think this is a very good gross margin, 40%. So I'm not saying nothing bad about the gross margin, but I'm saying that you have to consider that. So you're not just able to take revenue, you got to consider expenses. And so now, so that was the first major expense, um, the cost of sales, which gets into their gross profit. And then we must consider the other expenses. And so one thing that they have here is demand creation expense. That's a very interesting name, demand creation. Very, hey, demand is a cost. And so especially when you're creating it. And for Nike, it's a cost of $1 billion in that 3 month time period. And so not sure what that was exactly, but there were some things there. And so $1 billion worth. Other than that, we have the operating overhead expense, which comes in at 2.8 billion. And so these are overhead expenses, and that can be a whole host of things to get a total expense of 3.9 billion. And so we started off with a revenue of 11.3 billion. We ended up with a gross profit of 4.5 billion because we had to consider the cost of sales. And then we considered the other expenses, demand creation, and then overhead. And when you add up all of these expenses and you subtract it from the gross profit, you get the net income of 520. And, really, there's some other expenses you can consider. And so it's not just those expenses. You also have some interest expense. I didn't consider those because they were much smaller. Um, but you can still consider those. And so I should consider them. And interest income, 15 million. And so that was a loss. Other expense, 82 million. That's another loss. Actually, that's income. That denotes income. And so we'll have to look into the notes to see exactly what that is. So this is actually, it's a negative here. And so it has a like an opposite effect. And that's where they have interest and they have income in brackets. And so um and the income before income taxes is this 650. And so this is before income taxes. And so we consider a lot of expenses. We consider the cost of sales. We consider demand creation, the overhead, and then we consider the interest expense and some of the other items to get to the income before income taxes. After that, there's an income tax expense, and so they paid 130 million in income taxes. And so if you look at it from they had a gross margin, a gross profit of 4.5 billion, and they paid 130 million in income tax expense. And so um, it shows that a lot of their expenses are going to things outside of items related to the exact product of Nike. And so it's just something to measure from an administrative perspective, but they're still pretty good. Um, and just to look at it from the total income, they made 650 million before income taxes, and they paid 130 million in income taxes. And so if you were to do the percentages on that, um, roughly around 20%. And so Nike is paying an effective tax rate of 20%. And just to give you some, show the income tax rate for individuals, just to compare how corporate tax differs from income tax. So and I'll just go single. Well, I have to go married too. If you make 50 to 100,000 a year as a single person, you're paying 22%. So your effective income tax rate as an individual is higher than a corporation. Now, people have reasons for that, um, and so, but just to show the difference between corporate income tax as it relates to income tax. Married filing jointly, if you make 100 to 200, you're paying 22%. Now, if you're individual and you're making 12,000 to 50,000, you're only paying 12%. So you're paying less. Um, and then married filing jointly 24 to 100, you're paying 12% and you're paying less as well. So that's just to show you how corporate differs. But when you're dealing with a corporation, it's an ownership structure that they're really considering. And so they don't want to double tax. And so that's a whole nother thing. But that's the effective tax rate. All of that just to show the net income of 520 million. And so after that, we can go into the balance sheet. And from the balance sheet, remember assets minus liabilities equal equity. And so now there's a different way to do that formula, but let's just jump into the assets. So we have 37 billion here in assets, and we can already just guess without even looking. And we know a big part of Nike's assets will be their inventory. And so we know that just from conversation, but the numbers will prove it too. So out of this 37 billion, let's look within their total current assets. You'll find inventory, and that's let's call it 5 billion. And so out of this 37 billion, 7 billion of it is inventory. Now, other than that, some other big ticket items within their inventory is cash. And so, like cash in the bank account, all of that is considered an asset. And so they have cash of 6.6 billion. We covered the inventory, and they have accounts receivable, which is payments that they're waiting to receive. And so they count that as well. And so that's not cash, but they're expecting that to convert into cash. And so this is cash on that should come in a certain time period. Uh, so that sums total current assets, which would be 23 billion. Now, we spoke about a few ticket items in here. We spoke about the cash and we spoke about the inventory, accounts receivable, which are the bigger ticket items to make up this 23 billion, which is most of the 37 billion. So most of their assets come by way of inventories, cash, and accounts receivable. And so, which is pretty much to be expected. Now they have long-term assets, and most of that is their property, plant, and equipment. So any equipment that they have, their property, any factories, things like that, that's 4.7 billion. And so that pretty much sums up their assets that's worth talking about for this video. Liabilities, they don't have the total liability outline here. Every firm do the accounting a little different, and so we're not able to laser focus into the liability like single itemized item, but we can still find out the liability figure. And so for that, I'm going to use the formula that I've been speaking about: assets minus liabilities equal equity. So you have the assets here of 37 billion, and then you have equity here of 14 um, billion. So if the equity is 14 billion and we had assets of 37 billion, what is the liability? And so in this case, I don't know, 23 billion is the liability, somewhere around there. And basically I just did the assets minus X equal, this 14 billion. So a little algebra, I guess, basic algebra. Or is it basic? I don't know. But um total current liabilities, we'll start there. They have 10 billion. It's right here. So I said it was around 23 billion. This is 10 of it. And most of this is accrued liabilities. And that's very general. Who knows what that can include? It can include a host of things, but it's things that they owe and that they're expecting to pay out. And so they're expecting to, pay these people through cash. And so they will be paying these people. Accounts payable, same thing. Um, they owe these people as well, and so they'll be paying these people. And so these is some sort of bills that they owe. So that's around 9 billion right there. So that's really their current liabilities, just business bills that they owe. And if we go into their deeper, this is the press release financials. If we go into the actual financials, we could drill in deeper on that. And if there's a need to, we can. And so we talked about 10 of the uh, 23, 24 billion in liabilities, and the rest will kind of be summed up here. And 7 of it is long-term debt. Not sure what that is. Could be mortgages, um, operating lease liabilities. So they could be renting out facilities as well. And so this could be a liability for that. And then deferred income tax and other liabilities. And so we'll have to go into the notes to figure out what that is. But deferred income tax, meaning amounts that they should have paid prior that they're kind of reserving for just in case, like they need to make that payment. And so it's like a catch fund for any potential tax liabilities. And then that would be it. So we did the 10, the 7, the 21, another plus another 4. We'll get to that like 20 million in liabilities. And then the equity is here is 14 billion. And so quick review by the regions. Remember we had 11.3 billion in revenue. Most of that comes by way of North America here at 5 billion. Second on the list is EMEA, which is Europe, Middle East, and Africa, 2.8 billion. Then you have Greater China, 1.6 billion, and you have Asia Pacific and Latin America. And so got to consider Latin America as well, 1.5 billion. And that all of those sum up to this 11.2. And what is this? Okay, and this is earnings before interest and taxes. And so this is after the expenses. And so because we talked about the net income of 520, which was after we consider all of the expenses, and this is that same breakdown just by region. And so um, that's what this consists of. As we talked about before, North America is still on top, EMEA is still 2, Greater China is still 3, Asia Pacific and Latin America is still I guess 4th on the list. And that sums up the Nike press release financials. We'll probably go into more stuff if there's a demand for it, but if not, we'll probably just leave it here. Pretty good year, but hopefully you get better understanding of the assets, of the liabilities, the balance sheet, the income statement, and other accounting principles. Until next time, see you later.